Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Trading of futures and options contracts are halted on the Chicago Mercantile Exchange, the CME, due to a technical issue at its data centers, leaving investors without pricing on key assets on a thin volume day. Over in the States, President Trump announces a, quote, permanent pause to migration from, quote, third world countries. How could this affect an American labor market that's already softening? We'll dive into those details. And right here on this side of the Atlantic, Vladimir Putin says Trump's 28-point plan could be the basis for future agreements with no final version just yet. He's due to meet Hungarian Prime Minister Viktor Orban later on today, Guy.
It was always going to be a quiet day today, Kriti. It's even quieter with the CME outage. In fact, what you could argue is that it's kind of more interesting what's not trading this morning than what is trading, because what is trading is not very exciting. Euro Stoxx 50 futures, unchanged. Nothing to see here. Euro dollar, we've got CPI data coming up, pretty much unchanged. Brent's ticking up a little bit. We're up by 0.4%. That's where the excitement lies this morning. Crypto, actually, decent rally on the 5-day chart. You can see it coming up. We faded that a little bit, but still softening up a little bit. We're trading at 91.30, but relative to where we've been recently, that's actually a fairly decent number. But the CME story is where the excitement is this morning. It's what's not trading, and then what is trading is where the excitement is, as I say. And the countdown to the opening trade starts right now. Friday the 28th, good morning. America's still enjoying the kind of Thanksgiving Day hangover. That is what we are largely factoring into our markets here in Europe this morning. But we've also got this story around the CME. Turns out, Kriti, CME is quite important.
Who knew? I mean, just looking at the story this morning, the fact that you were affecting not just the commodities exchange, which, by the way, is what it's famous for in terms of trading that, futures, bond contracts, some of the FX options contracts, and not just in the States, but globally. You've seen Asia really panic around this.
So here's the interesting thing around this is that it's already a light liquidity day.
Yeah.
And in some ways, this is a big kind of pool of liquidity that we're then also taking out of the market. So what happens when it all restarts? Do we get this kind of big liquidity surge? Is that something that actually could disrupt maybe market pricing, switch around a few things? We don't know what's happening right now. We also don't know what happens when it reopens, because liquidity was already light and it's even lighter now. So when it all restarts, do we get a kind of a bit of a wave coming through? But yeah, it's an important story this morning. And I think if you were going to have a day when it was going to be out, maybe today is the day. But then you could also argue that if you were going to have a day that it was out, maybe today isn't the day, because liquidity is already fairly thin. Yeah,
because it's going to be a worse impact, to your point. I think the other piece of this as well is we're learning the limitations of data centers. And that was kind of my other key piece of this. When you look into, wait, what's the technical glitch? Well, it's cooling around these data centers that are powering basically the world's contracts at the moment. And yet, ironically, not European contracts. So the only pricing, to your point, that we do have is European futures. But the fact that we are so reliant on data centers, and to me, just taking one giant step backwards, it was this question of we're investing so much in these data centers globally on both sides of the Atlantic. And we have outages like these.
CyrusOne is the company behind this, Dallas-based. I think it's KKR-owned, partly KKR-owned. But yeah, this highlights the vulnerabilities within a system that is increasingly going to rely on these data centers. This is critical infrastructure now.
Yeah.
And every day we learn just how critical it is.
Every day we learn how critical it is. And to your point on the timing around the markets, I think a lot of people probably front-ran light volume Thanksgiving liquidity. But on Monday, you were kicking off a race to another holiday, and that's Christmas and to New Year. So I'm curious kind of how, one, if this does get solved by Monday, and I think the clock is ticking on that. And when it does get solved, what the market narrative is around that. Because I think then we're basically have a couple of data prints. We have a data print, we have a Fed meeting. I'm sure there's a few other central bank speakers in there as well. And then it's Christmas. At the same time, you're dealing with repo funding spikes, and at the same time, you're dealing with just tying things up with a bow.
Actually, weirdly, tying things up with a bow has already been done by now. The market's usually kind of in rundown mode by this point, and we are getting quieter and quieter and quieter. But it's not going to be like that this time. December's actually quite exciting. What is the Fed going to be doing? Are we going to be seeing some impact coming through from that decision? Are we going to get a rate cut? If it's a rate cut, is it a hawkish rate cut? What do we think about January? All of these things. So December normally is much quieter. I don't think it's going to be this time round. And November's been really whippy as well in terms of what we've seen. We've been on with that December cut. We've been off with that December cut. If you look at what has done well over the last month, Japanese assets have had a really poor time. Swiss assets have had a really good time.
Yeah.
That's to do with the tariff story. They've bounced back really quite strongly. You've seen a massive repricing of Australian rates and New Zealand rates over the course of the last month. So it's been, like, November's actually delivered some interest. Crypto's been all over the shop as well. So there's been an awful lot going on. But I think as you come towards the end of the month, what you do realise is that this dip that we've had, like, it's not real pain here that we've seen broadly across markets. We haven't had that big pain event. When does that come? Does that come? Is the Fed going to save us from that? Is fiscal liquidity going to save us from that as well? Are we ever going to see one of those big painful events again? Or do all the forces come together to provide enough liquidity to continue to insulate markets as they have done for the last 10 years?
And then, I mean, of the laundry list of potential risk factors, we left out whatever Donald Trump could be tweeting or truthing. And we've got an example of that overnight.
So there's a number of reasons why this is interesting, one of which is that it comes obviously on the back of the National Guard shootings that we've seen. So I think there's a kind of direct impact in terms of Donald Trump's policies and what he's trying to do in the United States and how those two connect. Incredibly sad, incredibly difficult for the United States to deal with this. Then I think there is the complication around how this affects the immigration story, which is already complicated. Donald Trump's push on immigration is already having a meaningful impact in terms of what we are seeing in terms of the data. Where is the break-even rate on non-farm payrolls now? I have no idea. But the fact that he is now talking about permanently halting migration from third world countries, that sounds big, but I don't know the specifics. But it just fits into a bigger picture of confusion around the labour market, which I think is really difficult for economists and markets, therefore, to navigate.
Trickier as well because, to your point, we don't actually know what third world means. 20 years ago, third world would have been India, arguably China as well. That's not the same conversation that we're having as well. I think when we talk about migration, though, and this is a conversation that happens in regard to some of the ICE raids that we see around there, some of the kind of visa issues, the visa halting. There is the immigration flow that comes into the hospitality jobs, the low-income jobs, the factory workers, the farms, et cetera. Then there's the kind of more maybe higher-esque group of software engineers that were coming from Seoul, from New Delhi, from Shanghai, wherever. And that's an H-1B visa conversation. And that's where you can start to see that conversation we have on the K-shaped recovery and the softening of the labor market. It really does depend which kind of sector of jobs you're actually looking at. And there is a fund, or sorry, not a fund, kind of a feed and a flow in terms of what that looks like. Unclear who he's targeting right now. The assumption is, given that it is off of and a reaction function to the Afghan national who was taken in response to the National Guard shootings as well. But that's what we're talking about. But again, that part of the world doesn't necessarily feed into the immigration story the way that others do. It's that third world terminology that's tricky here.
He'd already put a limitation on Afghan immigration as a result of the shooting. So this
and
is
a series of other Middle Eastern countries.
This is a broadening out of that process. But it's just, he's talking about reverse migration. Isn't that immigration? But immigration feels different to reverse migration. It's just, I don't know what this means, is the problem. And therefore, if I'm an economist trying to figure out what does this mean to my labour market model, it's just another complication that we don't understand at a time when the Fed's trying to figure out what on earth is happening in the labour market because it's got to make a really big decision come December. And we don't know. And I think that's the challenge right now. The fog that the Fed has had to deal with has lifted a little bit with the shutdown ending, but it's still enormous in terms of the lack of visibility is still really significant in terms of our understanding what is happening with the economy.
And we've been through this iteration with the tariff front where you saw businesses and who are still thriving, still making profits, just kind of pause hiring because they didn't know what the policy actually meant to your point. So that's another piece of this. Geopolitics, I think, a perfect place to go to next here because that's the conversation that's happening in Europe today. Vladimir Putin commenting on the 28-point peace plan from Donald Trump as well. He says, look, there's a basis here. We are nowhere near a final deal. He's also looking to meet Viktor Orban from Hungary, who, by the way, just had a trip to Washington, D.C., talking about getting an exemption on some of the sanctions coming from Washington. Now he's going to Russia to talk about the energy supply. So this isn't necessarily a tick by tick. We're not as close to a peace plan as maybe some people were hoping for a week or 10 days ago. But there is an energy conversation here to be had.
I think there's a stock market conversation. I think there's a euro conversation. I think there's lots of conversation. You saw how European futures reacted to the Putin comments. an inkling that there is a basis for negotiation caused equity markets to go higher. Mm-hmm. So what happens when we actually get a deal? How big a move could you see in European equities? How big a move could you see in the euro, which then feeds back into the dollar? Now, the dollar's everybody's expecting the dollar to weaken next year. Does this kind of make that trade much more certain if that were to happen? What's happening with, we're going to talk about CPI a little bit later on. What's happening with energy costs in Europe right now? One of the big standouts, you go to the GMM function on your Bloomberg, put in month to date, energy costs, gas price costs are down sharply this month. So there's a number of ways in which the story is going to feed into the European economy and into the European data and into European markets.
The second derivative of that conversation is, let's say you get a peace plan, let's say things are solved. Does that change the spending priorities that you hear from a lot of European governments? Does that echo into the bond markets and some of the budget conversations that we're having as well? And do you get rerouted in terms of some of that defense spending? All something that's going to be, I expect, a 2026 conversation to have.
Absolutely. But it feels like the run-up into Christmas, to your point, is going to be an interesting one. Valérie Noël is going to be joining us a little bit later. We're going to get her take from the C's Group head of trading there. How's the CME outage actually affecting what they're doing right now? Erin Brooks, Alvarez & Marshall, European retail and consumer lead, is going to be joining us as well. You out shopping today? Not trading, maybe shopping. Roelof Salomons, BlackRock Investment Institute Chief Investment Strategist, joining us in the second hour. David Hirschmann, Permira, Head of Private Credit as well. We've got some interesting conversations coming up on the show.
Let's talk about some of the data as well. And yes, there is some data, mostly on this side of the Atlantic. 10 a.m. UK time, we'll get the Italian CPI. Just 3 hours later, it's the German CPI at 1 p.m. UK time. Black Friday, as you said. But I've really got my eye on this Putin-Orban meeting. It's happening in Moscow. Let's see what comes out of it. Security conversations there, and it looks like there is an expectation between China and Russia to also have some security talks.
We'll carry on monitoring that story very, very carefully. Let me take you to Hong Kong and update you on what is happening there. Hong Kong Security Secretary says the death toll from this week's apartment tower fires has now reached 128. Dozens of survivors remain in hospital, with hundreds more left homeless as a criminal investigation continues into the cause of the disaster. China's top diplomat has used a call with his French counterpart to say that the two sides needed to support each other, underscoring Beijing's push to win diplomatic backing during a spat with Japan. Wang Yi said Prime Minister Sane Takaishi had made, quote, provocative remarks related to Taiwan this month. The French President Emmanuel Macron is due to attend a state visit to China next week. And Taiwanese prosecutors have searched the homes of a former TSMC executive suspected of leaking trade secrets to his new employer, Intel. It signals an escalation in the government's criminal investigation into the high-profile dispute. TSMC had sued Lo Wen-jen, alleging a high likelihood that he shared sensitive information with Intel, something the US company has, however, denied.
Coming up on the program, a focus on the corporate space here in Europe. Delivery Hero faces pressure from shareholders looking to divest from their investment. We'll look ahead to that stock at the open. Plus, back to the geopolitics. Peace talks still underway in Ukraine, or on Ukraine, I should say. Meanwhile, Germany, we're talking about the spending priorities, set to approve nearly 3 billion euros on arms, giving the sector another boost. But up next is our top story. Right back to the markets. The CME glitch that's impacting trading. Does it change how we approach the last 4 weeks of the year? We'll dive into that story. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. Just over 42 minutes away from the opening trade here in Europe. Futures looking positive, but look, it's the day after Thanksgiving. Everyone's got their Turkey Day hangover, maybe a little bit of a wine hangover, pumpkin pie hangover if you're American. But I think what's really crucial here is the FTSE 100 is your outperformer, higher by 0.2%, kind of higher by about the same margin. I should point out, these are kind of the only futures trading right now. We have this massive glitch coming from the Chicago Mercantile Exchange, which usually is typically associated, at least in my head, with the commodity space. It is affecting futures and trading contracts and options contracts around the world. These are just some and it's kind of wide-ranging in terms of some of the contracts affected. Let's start over here with the equities picture. If you were looking for pricing on American equities this morning, you are not going to get it, and we haven't seen it for a couple of hours now. Now, we can assume that because European futures are in the green, so would the U.S. future positioning. But again, all of the major indices are going to be kind of not active at the moment. A similar story for the rates and FX story. So far, SOFR rates are really important. Massive volume goes through that. You are going to see that. The European FX futures contracts, not spot contracts, are a key one. Keep an eye on that yen. Keep an eye on the pound. There's still a little bit of trading going on outside and after some of the budget talks in Japan and in the UK from this week. Keep an eye on those currencies. And, of course, the commodity story. We do have pricing on Brent, but we're not seeing it on NYMEX. And that's going to be something crucial, not just for when the Americans wake up, but especially given the holiday volume that we're seeing. We should point out that over in the States, because it's the Friday after Thanksgiving, those markets close early, but they are still open. And again, amid very, very light volume. I'll bring up the volume chart in just a moment. But this is crucial because this is one of the lightest volume days of the year. And it speaks this idea of just how much risk that it creates. And you can see that already the volume has been dropping in the lead up to Thanksgiving. Guy, does this make things better or worse today? I don't know.
I don't know. Actually, it's a really interesting question. You've already got light volume. You've got even lighter volume now. What happens when everything reopens? Do you get some sort of volatility wave coming through? There's a lot to think about here in terms of what we are getting. In some ways, you could argue it's a good day to have it. In some ways, you could argue maybe not so much. Valérie Noël, head of trading at the Seas Group, joins us now to maybe give us a take on all of this. Valérie, good morning. Thank you very much indeed. Let's just start with this issue of what we are seeing with the CME Group. You run a trading operation. How does it affect what you're doing this morning? What happens when it reopens? How are you thinking about this?
Thank you, first of all, to having me. Good morning to you. Yes, to answer your question, I think considering that yesterday was completely off in US and today it's a half day, that kind of issue, I don't want to say it's the best day to have it, but at some stage, yes. As soon as you cannot trade, if you can trade, obviously the client's going to have his price. But if you cannot trade because we have a technical issue, it's the same for everyone. So I think, to answer your question, I think it's not too bad to have this on this day where liquidity is very, very thin.
OK, there we go. Not a bad day to have it, I think probably is the answer. OK, we'll clear that one up. We've cleared that one up.
Especially the weekend after,
Yeah,
so they
like a lot of people would have taken today off anyway.
Yes.
So I'm assuming trading desks are reasonably lightly staffed, particularly over in the United States. Let's talk a little bit about what happens next then. We've had a November that has seen big swings in terms of some fairly significant assets. We've seen, obviously, the Fed being repriced. Are we going to get a cut? Are we not going to get a cut? Normally at this time of the year, Valérie, we're winding books down. We're closing books down. But it feels like actually this December has the potential to provide a few shocks. How are you positioned? How are you thinking about positioning your desk as you go into December and that all-important Fed meeting?
I think as November was like a wake-up call to some investors that the market can go down sometimes. So what we have seen is some diversification and rotation from investors. They were really like big AI tech from the beginning of the year to almost October. And then they just, realized that diversification would be very good for them to sleep a little bit better, maybe until the end of the year. So we have seen some movement, people going out, some tech who's been quite smashed from August to October. Some, lost like more than 20-25%, and going through like healthcare, going through financial. So we have seen this rotation, and I think people now position themselves more diversified, and they feel better for the end of the year. It's for sure that a lot of people are waiting for the Christmas rally. Is it going to come this year or not? But we have seen a very strong movement back the last few weeks. Few days, the last week. So I think everyone is positioning to do maybe some window dressing in December. But even if we are like 1.5% from all-time high and the screen are green all the time, I think people are starting to be very cautious of what is happening. And yes, everyone is expect to have the Fed cutting by a 25 basis point, 80% chance for 25 basis point. But we hope it's going to happen, because if it's not going to happen, volatility can come back very quick and very, very strongly.
Yeah. Well, Valerie, speaking of that volatility, how hedged are people going into not just December, but into the new year? We've had a series of guests on this program who've said that even though they're not necessarily shorting the market, they are hedging any additional positions that they're putting on into 2026. Is that what you're hearing from the people you're speaking to?
Yes. Yes, definitely. So first of all, they're diversified. So rotate, not getting out of US or AI, not at all, but just diversify. And yes, so we definitely see some people start to hedge for the beginning of next year. Us, we're still very positive for the equity market, especially US and large cap. But we are also start to look for example, the Russell 2000, because it's an index which got a lot of financial, healthcare, and industrial. So, yeah, well, we are focused for the moment for the large cap in the US, but start to watch what's happening on a mid and small cap.
Valerie, that's on the equity picture. Do you look at cross-asset hedges at all? I mean, it feels like the people who are hedging are doing it via very simple kind of NASDAQ put contracts, to your point. Do you do the gold, the Bitcoins, the treasuries to
Yes.
kind of round out the equity position?
Definitely. So gold is one of our topics since the beginning of the year. So we are very positive, very positive on gold. Overweight on gold for us is a very good diversified. On top of it, that's a safe haven, geopolitical tension. But we are very positive on gold. We see also some client hedging some US dollars. Because, we had a big drop in dollars this year. So people, that changed the mind of the way to view FX. So for some company who are based, as example, us as in Switzerland, that everything is Swiss franc. So when you have that kind of strong movement, that make people think or say, what do we do with the currency? So we've seen also a lot of people hedging their portfolio, also via gold, and via hedging the US dollars.
Valerie, can I just come back to the AI portion of the story that you mentioned a little bit earlier on? I'll talk a little bit about that. November has shaken some of our assumptions about the AI trade and who is going to lead the AI trade and how much money is going to be made from the AI trade. How much of that skepticism, that concern, that kind of lack of understanding, maybe is the right way of putting it, is still present? Are traders as convinced at the end of November as they were at the beginning of November about the AI trade? And how do we view it going forward into 2026?
I see people realize that as soon as there is AI, people was investing because it was AI related. But I think you have the leader. I think you have to separate the AI in 2 or even 3 silos. So you have the leader, and you have who create the infrastructure, and you have also, I think that another theme is like who's going to use the AI. So investor or people or clients start to separate the things. Okay, I want to invest in people who company who actually build the infrastructure for the future of AI, and you have also the other client or investor to think, okay, who's going to benefit for that? And I think that's the big silhouette we have seen since the beginning of November. And people start to realize also that it's not because you have an AI theme that you're going to be a company who's going to make money. So some they add too much depth on it, and so just people realize that it's not because you have an AI theme that you're gonna take like a 20 or 30% up the next month.
Fascinating. Valérie Noël, head of trading at Seas Group. We thank you so much walking us through what to buy in these markets. Coming up, we talk about what to buy in these stores, why the Black Friday discounts may actually be fewer this year, and how that affects the broader global economy. That conversation next. This is Bloomberg.
Friday the 28th, good morning. 30 minutes to the start of equity trading here in Europe. It's going to be a quiet session for a number of reasons. The main one is that it was Thanksgiving in the United States yesterday, as a result of which you don't have a great deal of volume going through the markets. But that is augmented this morning by the fact that we actually have a big outage at the CME. The Chicago Mercantile Exchange controls, as it turns out, quite a lot of the financial plumbing, and those are the contracts that you're looking at that will not be trading this morning. So if you're looking for a bit of price discovery, I think you're going to struggle. And we don't have pricing significantly on the S&P, on the NASDAQ, on the Russell, on the Dow. There's a whole bunch of FX that isn't trading this morning. You've got crude contracts that aren't. It's a big deal.
It's a big deal. Today, as we were just talking to our former guest, Valérie sees about the effect on it, maybe today's the day to have an outage. Let's hope it gets fixed by Monday, because that's when you will have traders back at their desk and wondering what things look like. That being said, let's talk about some of the pricing we do have. We talked about the European futures picture. Let's talk about the bonds picture as well. I can't tell you what the bonds picture in the States is doing because, again, you are seeing some of the futures contracts affecting the liquidity there. But I can tell you here in Europe, we are seeing literally nothing. I was hoping there'd be more excitement on that.
The reason is everybody's out shopping.
I was building
people are getting ready to go. They're not buying stocks this morning.
They're not buying bonds either, apparently.
They're buying T-shirts and TVs and...
Is that what you went shopping for yesterday?
Oh, yeah.
T-shirts and TVs?
They're the two top things on my list.
That's such a boy shopping list. I can't even talk to you.
It's not a real shopping list either.
Well, as you can tell, it is Black Friday. It's the unofficial start of the holiday shopping season, and we've got the perfect guest to set us up for it. To talk about not only the state of the shops and the discounts, I want to know where the sales are, but also just kind of how this affects the global consumer. Aaron Brooks, European retail and consumer lead at Alvarez & Marshall, joins us around the table. What's on your shopping list this morning?
Well, I think it's a great time to be buying electricals. To Guy's point, there have been really deep discounts coming.
How is Guy better at shopping than I am?
But I think there's also some really heavy discounts out in the beauty category this year, which has been quite a recent development in years. Usually beauty brands have been able to hold pricing, but at the moment, given that certain retailers are leading with heavy discounts, you can see discounts across the patch in that category.
Why are these discounts there? So why are those two sectors particularly affected?
Well, there's two pieces. Firstly, retailers plan to sell through an awful lot of stock this year, so they buy in, with the express intention to sell through. In technology, we've also had a new iPhone release, which will increase interest in technology products. And then in the beauty sector, what's interesting is that it's so competitive at the moment. You've got Boots, you have Sephora, you have in this market John Lewis, all competing for that holiday spend. And what we've seen recently in terms of search interest across the categories, that perfume is very, very strong. So consumers really searching for the best perfume deals, which means they're planning to gift that category over the holiday season.
Did you hear that? Now you know what to get me for Christmas.
You're not here for Christmas.
TBD. I'll visit if you get me a gift. Talk to us a little bit about how much is that a reaction to some of the kind of almost inventory hoarding that we saw earlier this year? There's a tariff component to this. I think if we had had this conversation April 2nd, we would have said by holiday season there would be empty shelves, there would be higher prices, and people would maybe have a tougher Christmas. I'm not getting that message.
No, what's really interesting is that the profile of kind of retail sales follows a really similar year-on-year profile, highly seasonal business with Christmas being the peak of trade. What we've seen over the past few years is that those sales build, and between Q1 and Q4 with an uplift in Q4 of about 15%. This year, we've had a negative trend between Q1 and Q3, meaning that if we get the same profile and we lift 15% from our current negative base, there's about 6 to 10 billion of retail sales at risk this holiday season. So, Kriti, to your point, I think we've got a lot of inventory that needs to be sold through. We've had unseasonably warm weather, which means there's quite a bit of apparel that retailers in the UK need to sell through as well, and that presents as discounts and great deals for shoppers.
Shopping is not my natural kind of place.
I never would have guessed.
Shocker. I am the Grinch when it comes to shopping. But how is the UK consumer? I just had a budget yesterday that is going to raise taxes. We've got a story across Europe that is fairly dismal, to be honest. Yes, inflation may be more stable on the continent than it is here, but what is the consumer picture looking like right now?
So consumer confidence usually month-to-month increases at this time of year. So if we look at between October and November, it's the first time that it's decreased in this month between October and November in the UK since 2021.
Wow.
And we believe that that's related to lack of confidence, lack of consumer confidence, lack of confidence in personal finances related to the budget. The budget timing this year for consumers and retailers has been really tough because it's meant they've been unsure about the picture going forward.
So what happens? Do we get clarity? Now we've got the budget, do we get more clarity? Or is it still, is your sense that actually this isn't going to change?
I think there's a few pieces to that. In terms of the UK consumer, minimum wage rise will be welcome news to some segments of the population that are dependent on that and will feel a little bit more cash in their pockets. That's quite positive. However, a high degree of workers will now be dragged into higher income tax brackets due to the threshold freeze. So overall, I think it's still there's not really a lot of reason to be super hopeful.
I'm sure Kriti sees the world through K-shapes because, anyway.
Finish that sentence, Guy.
Is the UK K-shaped? How K-shaped? We talk about the kind of K-shaped consumer in the United States. The upper echelons are spending all of the money. The lower quartiles are not. How K-shaped are we here? Is it different or is it more evenly spread in terms of what we see in terms of the distribution?
So I think historically it has been a little bit K-shaped, Guy. However, this budget is going to really flatten the more wealthy and more affluent from spending more, particularly people that are depending on retirement income, that are seeing kind of persistent inflation, that are seeing Rachel Reeves mentioned she wanted to address the cost of living crisis. I'm not sure we have solved that in the last few days. So I think that puts pressure on the top end, certainly.
Does that increase the inclination to save then? Does that just mean if you have a little extra cash in your pocket and you don't spend it and it's not paid to the taxes that you may or may not have to now pay, does that just go, is that cash under the mattress?
I think, the consistently, what would be great is if we could start to achieve a bit of relief rather on interest rates. I think that would create some liquidity in the market. As long as interest rates remain persistent, people will be trying to save a little bit, but also pay down any debt that they have. Interestingly, when we've looked at search terms in terms of consumers looking for things around Black Friday, payment options has been extremely high this year, has been really spiking. So consumers looking for alternative ways to pay is also really present at the moment.
Like a buy now, pay later.
We had a buy now, pay later budget yesterday, so why not have a buy now, pay later sort of economy?
Dynamic, yeah absolutely. Aaron, I'll end on this. We kind of started the conversation with what pricing and what sales and that kind of piece looks like. And you mentioned that a lot of retailers are trying to get through a lot of their inventory. In Europe, there's been a conversation here that if a lot of the Chinese, Vietnamese, Malaysian, et cetera, goods don't make it across the Pacific to the States, they get rerouted off of tariffs to Europe. And that ultimately leads to overcapacity in Europe and feeds into deflation. What does the timeline of that scenario look like? Are we talking about 2026, or is that something that's a little bit more near term?
I would have thought it's a 2026 impact. Retailers will have really been planning for any tariff-related impact and talking to their supply base about ensuring that overcapacity doesn't adversely affect them. But we need to see that play through.
Aaron, great to see you. Thank you for stopping by. I'm sure you'll be doing some shopping later. Aaron Brooks, or at least figuring out what everybody else is shopping for. Aaron Brooks, European Retail and Consumer Lead at Alvarez and Marshall. Now, Kriti was mentioning what is happening in terms of the China trade. Let's get some more detail and colour around what is happening. We've obviously got a huge impact that China has in terms of global trading. And Bloomberg has put together a picture of how China has built a global network of commercial ports, pretty much on every continent, except Antarctica, to develop its trading platforms. Today, Bloomberg Originals documentary reveals how these ports are China's advantage amid President Trump's trade war.
Every year, China imports about 66,000 metric tons of these. That's the weight of about 6.5 Parisian landmarks, or if you like, 440 blue whales. And most of these avocados come all the way from Peru. This journey used to take over a month. Now it's a straight shot, cutting it by 10 days. Why? One word: megaport. And it's paid for by China.
Well, Chinese President Xi Jinping begins a week-long South America tour, opening a China-funded mega port in Peru.
This is a huge investment, not only for Peru, but in Latin America, and it is expected to triple agricultural exports of Peru.
Over the last 20 years, China has built up a network of about 100 ports on every continent except Antarctica, clustered around key maritime choke points, which are crucial to global trade.
This gives China a strategic advantage as global trade tensions rise. But it's also sparking concerns.
Even though these ports by and large are commercial ports. Some of them do actually have the capacity to host naval vessels.
And hang on to that last thought. You can see that and other Bloomberg original video documentaries just go to Medishow Go on your Bloomberg, MEDISHOW. Just to be clear, we put it on the screen, just there for you, right other side. Coming up, we're going to talk more about this. This is interesting in many different ways because that feels like that last point about geopolitical kind of impacts of these ports, I think, is going to be hugely significant.
It's fascinating. We saw it with the Panama Canal kind of debacle. Yep. We saw Donald Trump really going after this. And this is part of the Chinese build-out, and part of the overcapacity issue we were just talking about, Aaron Brooks, as well, that if you can't send it to the States, the biggest consumer economy in the world, you have to have the logistics and the infrastructure to do it everywhere else.
OK, coming up, there could be big moves in defence stocks today. Germany approving $2.9 billion in military deals. We're talking about a whole range of equipment. How's that going to show up in the market? We will find out next. 18 minutes to go until the opening trade here in Europe. That's a British ship. That's BAE Systems. That's not Germany. But anyway, we'll come back to it in a moment. This is Bloomberg. How's the ECB feeling about inflation? We are finding out. Let's talk a little bit about what we are getting out of France first thing this morning. This is November preliminary data for French CPI, and it comes through soft. On a month-on-month basis, this is November data, as I say, negative 0.2%. The prior number was a plus 0.1. The expectation was for a flat number. That means that the year-on-year number is now 0.8, just 0.8. On French year-on-year CPI, the harmonised number. Expectations, therefore, 1. Remember, the target is meant to be, let's call it circa 2%. That's where we're meant to be here, but we are not getting that. Yeah, I think it's fascinating as well. So when you look at kind of where the pain points actually are, you're talking about food prices actually rising, but energy prices dropping, and that's a dynamic I would have thought would go in the other direction. The other piece of this is the services story. We've continued in France to monitor the services conversation and see whether or not it's actually affected by the geopolitical domestic political volatility. And time again, we're not really seeing it actually show up in terms of a data impact. It's quite weak, though. That's a weak number. Yeah. If you were to take that number in isolation and says that's the Eurozone number, you'd be thinking that the ECB is going to be cutting rates right now. Now, clearly, other countries within the region are not posting these kinds of numbers. Yeah. So France does feel weak right now in terms of the data it's delivering. Not maybe as weak as you could argue you would expect, but nevertheless, it's going to be interesting to see what the other data kind of tells us and about where actually the ECB is going next. Is the ECB really done? Is there still a push lower potentially for the ECB? It's interesting, other central banks around the world, you see what happens in Australia and New Zealand, maybe starting to sound the alarm again about inflation. Yeah. It doesn't feel like it's that problem yet here in Europe at the moment. Well, German CPI coming in at 1 p.m. UK time, Italian CPI coming in at 10, so we'll kind of be able to compare and contrast from a market perspective. 115 on euro dollar, not much reaction, but again, that might just be because we don't have that much visibility and that much liquidity. We also don't have that much data because of what's happening in Chicago or in Dallas or wherever else it is. Let's talk about what we're seeing or not seeing this morning. So the Chicago Mercantile Exchange has something of an outage. This is data center related. There is a cooling issue in one of the data centers, we understand, and that means that prices are not being published. Now, as it turns out, and this is slightly tongue-in-cheek, of course, the CME is quite important when it comes to market pricing. And as you can see, these are the contracts that are being affected this morning. So you could argue that if you're going to do it, today is the day to do it. You've got light liquidity anyway because of what's happening with Thanksgiving. But nevertheless, these are still significant contracts that are not trading at the Chicago Mercantile Exchange. Now, I bring up the fact, I keep saying Chicago Mercantile Exchange. Why do I say that? Because there's two CMEs that we need to focus on this morning, one of which is what is happening in Chicago. The other one is what is going on with Kriti Gupta, because she has a caught my eye a CME for us this morning?
I feel like the Chicago Mercantile Exchange stole a little bit of my thunder this morning, and I'm a little but I'm a little bitter. I'm newer. Newer's always better. I think that's fair. I want to bring you a chart that is important because in the context of what's going on with the Chicago Mercantile Exchange, we are seeing this liquidity environment which could either magnify or suppress some of the market reaction that we're getting. Maybe today is a good day to have an outage. Maybe it actually magnifies some of the risk. But that's a conversation we've had regarding repo rates as well. I know it's a brutal transition. Stick with me here because going into the end of the year, as there is low volume, as there is people kind of rolling things off their balance sheets, when you do see these funding pressures, which we have seen, I want to say for about 2 or 3 months now, you can kind of see it in these little spikes that keep coming up. This is the blue line, and the big one that came up recently. It's been addressed by the Federal Reserve. It's something that they're watching. It hasn't actively been a massive, massive concern until it gets magnified, and that's where the volume really matters here. Is a similar story that we have with the outage today in terms of those future contracts. When you don't have a lot of volume, when you have people trying to roll down their balance sheets, especially going into holidays, especially going into year end, it magnifies the effect. And this is just one of those risks, Guy, that I want kind of lingering in the background because it's something that Valérie, our markets correspondent, flagged to us months ago, and we were all kind of like, oh, it's fine, it happens once in a while. These are getting more and more frequent. At what point does it start to hurt things like the equity market?
Absolutely. It's certainly one you want to be paying attention to, and we will continue to monitor what is happening here with the plumbing of these markets. Let's talk about these markets and trying to figure out where we are as we come through to the end of November and start December. A December that normally is quiet, but this time round feels like it won't be. We're watching, obviously, very carefully what is going to be happening with the Fed. The big risk, it seems, on many people's trading books going into next year does appear to be what is happening with the dollar. The expectation for most people is that it continues to weaken, and obviously people are hedging against that. What have we got it going the other way? What is driving the dollar trade right now? What are the factors that you need to be watching? Well, let's try and answer some of those questions. Market Live executive editor Mark Cudmore joins us now. Mark, the dollar.
I think we resume the structural depreciation trend next year. I think there are potentially a number of factors around that. The most important is because of the Trump administration's pressure on the Fed, we know that the setting for monetary policy, wherever it's at, will be easier than orthodox economics would recommend. And that is at a point when the rest of the world is generally coming to the end of their easing cycles. I still think that the trade dynamics has an ongoing pain. It is true that it had less pain from the trade war than many expected, but it's still continuing to seep through to the economy. That's a bit of a negative there. There's an argument that some part of this year, second quarter, third quarter this year, saw repatriation flows from U.S. corporates for their U.S. domestic capex under pressure from the U.S. administration, that's now largely run its course, and that's what kind of propped up the dollar over the last kind of 5-6 months. On top of that, I still think diversification trade continues, and I think particularly in Europe, we will see hedging ratios continue to escalate as well. So there are a number of dynamics for the slow and steady dollar depreciation trend to resume in 2026. When exactly to get on board that? That's harder to say.
If there's dollar depreciation in 2026, does that just mean the stock market's going to go higher and higher because it's cheaper to enter the S&P 500?
A weaker dollar is an easing of financial conditions. We have plenty of liquidity out there. I think the global backdrop remains good for stocks, but it's more of a benefit for the rest of the world. It's more of an easing of financial conditions for the rest of the world, and it also amplifies the returns that you get from foreign investments, which is going to further encourage those diversification trades. 2025 was about the end of U.S. markets exceptionalism. We saw that the U.S. saw a declining share in its share of global market cap, and that will resume further in 2026, and the dollar is a key part of that. So you're right, Kriti, that it's a stocks positive, but it's not so much a U.S. stocks positive. It's much more of a positive for the rest of the world and encourages that diversification trade.
Mark, can I just come back to this issue of the Fed and the fact that the Fed is going to be under pressure to cut rates? How does the market react to that? Because this is the bit that I can't get my head around. So many people I talk to in the market believe that the Fed is going to be forced into cutting rates effectively, that it's going to cut rates maybe more than it should. And is that going to be seen as a good thing? Or does at some point we get a weird reaction from the market?
I think the general consensus is they'll cut rates a little bit more aggressively than they would have done without that pressure. Not that they're going to kind of completely abandon independence wholeheartedly, but ultimately that kind of juicing at the margin is good for asset prices. Now, at some point, yes, you'd expect that this might see a steepening of the curve and concern about the central bank situation. But we've not seen any sign of that yet. Steepener has been one of the kind of widowmaker trades of 2025.
Yeah, a fascinating conversation that we're going to continue to monitor in 2026. Mark Hudmore there, our Bloomberg Markets Live executive editor. We thank you so much. Let's go from the macro to the micro. Get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's keep an eye on defense companies today, as Germany is set to approve 2.9 billion euros worth of procurement contracts. So a lot of this will be going to those domestic companies that we can see here in green on the screen, but also Kongsberg, which is a Norwegian defense company, is also said to be one of the few foreign firms to get some of those contracts. So we'll see how those companies react this morning. Moving on to delivery companies and staying in Germany, Delivery Hero is under pressure from big shareholders to sell the company, or at least parts of its business, to reverse the stock decline there. We can see it has been struggling quite a lot, underperforming its peers, and it is under that pressure right now to be potentially streamlining its operations and reverse that decline. And finally, we are moving over to Nexperia. Nexperia, the chip maker, has warned that some of its customers are facing a continued disruption to production and has reached out to its Chinese subsidiary, urging it to resume negotiations. Nexperia is known for providing chips to the automotive sector, and therefore we'll be keeping an eye on some of those car makers that have been facing that disruption.
Okay, Chloe, great stuff. Thank you very much indeed. Equities reporter Chloe Melly. Futures actually okay this morning. All things considered, we're flat. I think that probably is all you need. Anyway, we'll bring you the market details in a moment. Sectors and single stocks are going to be quite interesting today as well. That's next. This is Bloomberg. Friday morning, good morning. It was already going to be a quiet session, but now we have an outage at the CME, the Chicago Mercantile. So we don't have things like US futures or WTI contracts. It's bleeding into what is happening with the FX story as well. So what was already a light liquidity session has become an even more light liquidity session. What we do have are European futures. So let me just give you an idea of what is happening there and show you what the story is. I would like to bring you some excitement, but I'm slightly struggling with that as well. The FTSE is outperforming, which is nice. So the FTSE 100 is up by 0.3%. Is that in any way budget related? I'm not entirely sure, but let's kind of at least take note of it. DAX futures absolutely becalmed. Keep an eye on defence stocks, though. Chloe Melly was bringing us that story just a moment ago. You do have a further tranche of German defence spending coming through today, contracts being announced. That will be significant too. Euro Stoxx 50 futures absolutely becalmed at the moment. It is, though, remember, the end of the month, so that's a factor that you need to bear in mind. We are going into December, which would normally be super quiet, but actually I think this time round maybe a little bit more exciting. We have this small matter of a Fed meeting still to come. Plus, you've also got this issue around what is happening with Donald Trump's announcements this morning on immigration or forced emigration. We're going to see what happens on that front. That further makes the labour market picture in the United States a little bit more complicated, Kriti.
Yeah, a couple of micro stocks to be keeping an eye on, even though it is a light liquidity environment. The German defense story is going to be front and center. It looks like there's even more funding coming out of the German government. It's not just for German companies. You've got the like of Kongsberg, for example, that was named in that story. We've got some potential M&A on our hands. Puma has been moving quite a bit in the last couple of days. It looks like the latest line of this is that ASICS denies report of interest in the acquisition. And then, of course, Delivery Hero, a similar conversation guy.
Okay, so I'm going to try now, Kriti, to make the European equity market open sound exciting. I'm going to struggle, I think, because we don't know what's happening in the States. To be honest, there's not much happening here in Europe. We've just seen a French CPI print, which is pretty much in line with expectations, maybe a little bit softer. Does that take some of the story away from Europe this morning? Maybe it changes the dynamic around what we're going to see with rate cuts from the ECB. But the Stoxx 600 is absolutely flat. Literally nothing to see here. Stoxx 600, nothing moving there. The FTSE 100 is up by 0.2%, so as anticipated, a little bit of outperformance. What are we going to see on the CAC Quarante this morning? Well, I can tell you it's up by 0.1%. The DAX, you know when there's nothing happening, when I'm still talking at this point and the German market is open. Kind of that's your big signal this morning, that the DAX is open and absolutely doing nothing. The IBEX is doing absolutely nothing. The Swiss maybe still getting going. But the fact that the Germans are up and running this morning, Kriti, tells you, I think, everything you need to know.
It really does, and I don't blame you. I think what's interesting on that board, though, is that of all the regions, the IBEX is actually turning negative. It's a little bit of a mixed picture in terms of the sector story. So I'm going to start with stocks, and then we'll get to the macro in a moment. So when you look at it from a sector perspective, you can actually see that banks are, for example, in the in declining. It's where you see all the weakness as well. You also have a conversation here coming in the basic resources, the chemicals, a little bit of a slightly defensive tilt. It feels like a rotation, though. Right off the bat, I'm looking at Shell, Total, BP. They are your biggest index contributors to the upside, alongside the likes of LVMH. On the surface, to me, that feels like a cyclical bid. To the downside, I'm seeing an SAP and a couple of the banks that have been actually seeing quite a bit of a boost lately. So BNP, for example, on the back foot alongside some of the tech names, UBS joining that front, including even Nestle is on the back foot. So that defensive trade from yesterday has kind of reversed as well. This is a rotation. Is
not a very exciting one, though.
I mean, I'm trying to sell it. I think I did a better job than you. No, I'm kidding.
Okay, fair enough. You probably did. Let's move on to actually some of the data we're getting this morning, which I think is actually more exciting and more interesting than what we've seen in terms of the equity market performance. We've seen CPI data coming out of France, a little softer. We're now getting CPI data coming out of Spain, an economy that is on the front foot and has been for quite some time. So month-on-month data there, 0.2, up from the survey of 0.1, but down quite sharply from the prior number, which was 0.7. However, Spanish CPI is still quite hot, relative certainly to French CPI and certainly relative to ECB expectations. So year on year, the number is now 3%, down a little bit from 3.1, but still quite hot in terms of the average across Europe. And the core number is 2.6. So again, above target in terms of what we are seeing out of Spain. Retail sales, we've got some data there, softening up a little bit, but nevertheless, this is an economy, this is a part of Europe that is doing quite well at the moment.
It's doing quite well. What's really interesting about the Spanish economy, I'm going to take my moment to nerd out here about all things Spain, is that they are very exposed to the same issues that Germany is. So if you're worried about Chinese overcapacity, if you're worried about weakness in the auto and the manufacturing sector, well, Spain has the biggest or second largest, I should say, market for that, in line with the likes of Milan as well. So you see Spain being really exposed to that. The other piece of this that I continue to see in some of the data is these increases in food prices. And this is really important. You don't make as much money in Spain as you do in other parts of Europe. So the food inflation actually has a bigger read-through into that economy and some of the inflationary and wealth pressures than other countries.
Little tick down in the euro, though, which I think is interesting. Is this the market signalling maybe actually... the Spanish data is a little softer, so relative to so maybe that's just an expectation story. But is there a signal maybe in here that maybe the ECB is going to have to do more? Is the market just at the margin maybe signalling something around that? This is the messaging at the moment coming out of Christine Lagarde & Co., and I think there's a few of them speaking later today, is that we are fairly stable at the moment. They're comfortable with where they are at the moment. But is there this risk that maybe they go again? And if there is that risk, how does that affect the dollar trade, which so many people are worried about going into 2026? That feels to be one of the wild cards for next year.
And what's so fascinating about that is it's largely a euro-driven trade. The confidence and the strength of the euro right now is fascinating. I've seen forecasts there for the likes of 122 as a high going into the first quarter of 2026. So pretty fascinating. But let's talk about how we should be positioning, not in 2026, but maybe just in the last couple of weeks we've got in 2025. We've got the perfect guest for it. Roelof Salomons, Chief Investment Strategist for the Netherlands and the Nordics at BlackRock Investment Institute, joins us around the table. Welcome. We are digesting, we're thrilled to have you. We are digesting a ton of information, but let's maybe start with the near term. We're about to wrap things up. Where, of course, today's a light holiday trading kind of volume, but we're about to wrap things up for Christmas and New Year. Do we just sell into the New Year?
No, I wouldn't think so. I think what we've seen, and you just mentioned a few comments on Europe, I think if you look at what Europe has been delivering so far this year, it's pretty resilient. We've seen the best composite PMI since 2 years. You talked about Spain, which is the poster child of Europe. Financials are still doing well. And I think what we've seen so far this year is basically geopolitical fragmentation forced Europe into economic leadership directing. So it's a bigger story, and it's not a story to be selling into year-end.
Is there a catalyst going into 2026? I mean, what is the thing that everyone is watching for or positioning around? Or is it just kind of hedge your bets until Donald Trump tweets?
I think what you mentioned earlier, Germany is announcing some defense spending later today, so that story will continue to build. This is a story that is basically a big change compared to where we've been over the last decades. Fiscal policy is no longer a brake, but it's an accelerator. So I think that's a big change. That story will continue, and I think what the next step will be that people will be focusing on where the next reform is going to be, because we need to get that productivity in Europe up, we need to get that competitiveness up. And that's the next phase.
When does the German fiscal push show up in the data? Because I'm not seeing it yet. When does that happen?
It is not easy to build a lot of infrastructure and to build a lot of new factories. So I think we shouldn't be surprised that it's taking a bit longer. But I think we want to see that in 2026.
Do you think the ECB is going to need to cut rates again?
It's a coin flip. We've said it's a coin flip, and I think they will continue to be sitting on the fence. They're in a good place now. The CPI numbers, as you mentioned, a bit soft on the soft side. So, but it would probably change the probabilities a bit, but it remains a coin flip. They don't need to.
In terms of the way that you should view Europe right now, currencies are a big factor. How do you think about? If I'm a euro investor, I'm flat on the S&P so far this year. I've done well in Europe. Is that a trend that continues next year? Is the euro-dollar rate going to be one of my critical inputs in terms of whether or not I'm going to perform?
I think the two arguments to this. One is for a European perspective. I think it's about the domestic growth story. It's about the financials. It's about any sector that gets a boost from all the spending. So this infrastructure, defense. But if you take the other side from a US perspective, if you are buying Europe, you get an extra benefit of hedging the currency. So I think that's a story that not often people talk about. But if you are a US investor and have been buying European equities, you've done very well.
How expensive is it to hedge right now?
It's the difference in short-term interest rates, so it's still lucrative to do it from a US perspective, and it's expensive to do it from a European perspective. I think what we've seen on dollar hedging from the clients that I'm talking to, we've seen some increasing dollar hedges. Not selling off US equities, less buying, but increasing dollar hedges.
Let's go a step further. How expensive is it to short right now?
Short currency or short
equities?
It's. I wouldn't advise people to short equities in this environment. This is an environment where you want to be pro-risk. Growth is okay. Central banks are easing policy, so it would be expensive to short.
What about valuations?
Valuations are. Let's be clear. We're not cheap.
Yeah.
We're not cheap, but in an environment where growth is okay, where interest rates are being cut, there's plenty of liquidity.
So interest rate being cut matters. So the Fed has to cut, right, to keep the market where it is?
I don't think they need to cut to keep the market where it is, but I think...
Okay, so they don't cut. Say they don't cut. Where does the market go?
It depends a bit on what the expectations are for next year. I think for next year, people are looking at 2 or 3 cuts for next year.
Yeah.
If that comes into jeopardy, there might be a risk of a bit of less liquidity in the market.
Yeah.
But if they don't cut because growth is okay, then we're all happy.
Okay. So the equity wins either way.
Not wins either way, because you need to deliver on the growth numbers. But I think so far any company has delivered on the profit expectations.
Okay.
How much of what we're seeing in the States is what we're going to see in Europe? Are we going to see a divergence between performance, or is Europe just kind of following the U.S. lead?
I think that there's a difference here in the European story, because the European story has been very concentrated in the financials. Financials have been doing really well over the last couple of years already. This year we're seeing it broadening out in terms of the sectors that are driven by the fiscal spending.
Yeah.
I think if we're right and we think that there's incremental changes coming up in terms of reforms, etc., this will spread to pharma, this will spread to other sectors, to more cyclical sectors, and if growth really picks up, then you have a broadening instead of a more concentrated market. And I think that would be good. That'd be good.
But just let's talk about the fiscal spend for a moment. Yeah. What happened to all the worries about the U.S. over borrowing and all the European economies borrowing and all the spreads blowing out on the long end of the curve and all the conversations we were having in literally 2 years ago, but also over the summer? Does the equity market care about what's going on in the bond market?
The equity market certainly cares. I think the big difference, if you're comparing U.S. or Japan or the U.K. to what's happening in Europe, that it is driven by the countries which have the ability to borrow. Call it the Germans, the Dutch, the Nordics, but now also have the willingness to borrow. And I think that's a stark difference compared to the story around fiscal discipline and fiscal issues. So I think people should recognize that.
What's cheap going into next year? What still looks like good value?
I always make the pun that Europe is unheld, unloved, and undervalued. So
okay.
that's
Europe,
one.
basically.
Europe is cheap. Parts of emerging markets are cheap.
Yep.
Anything which is unrelated or not correlated to the AI trade is predominantly cheap. The market is pretty dispersed. So you need to look at areas where things are kind of different compared to just, you don't want to hedge your one trade.
Where do the risks lie going into 2026 for the setup you've laid out?
The risks are predominantly on the geopolitical side, but it's hard to predict.
But the market keeps ignoring that.
Yeah.
Let's talk about that.
The market keeps ignoring it because the guardrails are still in place, right?
Okay. So we can keep ignoring. Are the guardrails going to stay in place?
The guardrails will stay in place because you can't have bond yields rising because you have a debt to GDP.
So we can ignore geopolitics. If the guardrails are still in place, can I ignore geopolitics?
Yeah, I think so.
Okay, fine. If there was peace in Europe, what would that mean for European equities?
That would be a boost for European equities.
Okay.
Because valuations are at a discount, so if there's peace, that risk premium goes out of the market. That'd be good.
But it's not. But you wouldn't. The biggest drivers of the European market have been defense spending. If you start to see the political will or the political urgency around that defense spending change, wouldn't that undermine, just from a pure weightings perspective?
This is not the defense spending, the infrastructure spending, the energy spending. Those are not just pure cyclical and tactical trades. Yeah. These are decisions that have been made on the back of geopolitical fragmentation. We need it. We need to invest in the safety of Europe. We need to invest in the competitiveness of Europe.
All of that's
true.
That
will continue.
But we know that, and it must be in the price. And therefore, at the margin, if there is a little bit of a de-risking on the geopolitical front, don't I have to take that out of the price that I've got over here? Because I already know all of what you've just said. So at the margin, do they become slightly less attractive assets?
At the margin, that you would probably argue for a rotation in the market, which would mean that all the other sectors would continue to do well then.
Right.
So you lift all boats, effectively.
But which sectors would I look at? Is it the consumer would feel better? Would I be seeing... where else would I be seeing, potentially... does the chemical sector, which has been really hit hard by higher energy costs, start to maybe pick up a little bit? Are some of those kind of cyclical, more more industrial sectors, do they do better?
If you continue to invest in infrastructure and energy transition with the aim of lowering energy prices, which are twice as high in Europe as they are in the US, and you deliver on that and continue to invest in that, then these are the sectors that you want to be owning going forward.
On a
medium to longer term.
Great to see you. Thanks for stopping by to see us. Really interesting conversation. Salomons, the Chief Investment Strategist for the Netherlands and the Nordics over at the BlackRock Investment Institute. What are we seeing this morning in terms of the call six? Quick look at what we are getting. Obviously, some of the defence stocks are going to be in focus this morning. Rheinmetall is a little softer this morning, but not by much. Chips not doing very much. China's up by a little bit. The defensive trade, which on this board is Nestlé, is a little softer this morning. Pharma and luxury having a slightly better day. Is that because we're going out and buying nice handbags at LVMH? I don't know. Maybe that's a line I can draw between one and the other. Anyway, Chloe Melly's here with the details of what else we're watching. Over to you.
Good morning, guys. So Delivery Hero is up quite strongly this morning. We're up 6%. This is a company that is under a lot of pressure from several big shareholders to sell the company, or at least parts of that business, to streamline loss-making operations and reverse some of the stock decline that we have seen over the last few months. This follows a period of growing consolidation within that food delivery industry, and it seems that Delivery Hero will be a part of that going forward as well. So definitely something to watch going forward. Moving on to Puma, which is down this morning at 2.8%. This follows a really good day yesterday for Puma after reports that it was drawing quite a lot of M&A attention, but ASICS over in Japan has denied any interest in that company, and therefore we are down this morning for Puma. Moving on to Burberry, which is also down this morning. It is down a little bit over 2% after being downgraded by JP Morgan. The company had reported very reassuring, encouraging earnings that had boosted confidence in its turnaround and in potentially a broader recovery in that luxury sector. But it seems that now the lack of enthusiasm from JP Morgan analysts is dragging down that stock, and we are down 2% for Burberry. And finally, let's end with a positive movement for EasyJet, which is up 1.9% after being upgraded by analysts at Bernstein. They said that EasyJet was a really cheap play for investors to benefit from all of the supply constraints that we are seeing currently in the European airline industry, and therefore we are up this morning for that airline.
All right, Chloe Melly from our equities team walking us through some of those early movers. Very light volume day. We thank you so much. Coming up on the program, we go right back to our main story. CME futures and options trading halted after a data center glitch. We're going to look into the market impact. Today might be a good day for it. Could also be a bad day for it. We'll give you the full analysis coming up shortly. This is Bloomberg.
Welcome back. You're watching the opening trade. Quietest session underway here in Europe. Very quiet session, obviously, over in the United States. Now it's the day after Thanksgiving. Black Friday, people are shopping, people are digesting the huge amounts of turkey that they ate yesterday. All of those things are true, and they happen every year. But this year, it is also a little bit different. The reason for that is simple. The Chicago Mercantile Exchange has halted trading of commodities futures and options. It's having technical issues. This relates to a data center that is having a cooling issue. Nicholas La joins us now to talk about all of this. Nicholas, just give us a sense of what is happening here. This is a critical piece of infrastructure. What do we know about what's been affected?
So it's a dark Black Friday for the US, and traders who were hoping for a quiet session indeed got more than what they bargained for. It's very clear that this is an unprecedented outage. Now, the last time this happened was 6 years ago in 2019, and even then the outage only lasted for around 3 hours. It's been more than 5 hours since 10:40-something-ish this morning Singapore time when the outage started, and there is still no end in sight. Let me give you some context here. The Chicago Mercantile Exchange covers a suite of asset classes of options and futures. I'm not just talking S&P futures. I mean across a whole set of commodities. WTI NYMEX is traded on CME, agricultural assets as well as metals. So this is a big deal, and it's all happening on a day when most people weren't expecting it.
Talk to us a little bit then about when we're talking about kind of the operations and the resumption of trading. Just walk us through a timeline here. How long does this take? Is this hours? Is this days? Are we going to be back to normal on Monday?
The short answer really is we don't know, but I can tell you what's led to this, and I think that will give us a sense of where we're going. So the short version really is that CyrusOne, a data center provider, now one of their units had a cooling issue, and that's caused the outage that we're seeing on the exchange, right? So it comes down to the hardware. I think it really depends on how soon they locate the outage, process it, and get things up and running. But one more thing I will add to this, even though it is supposed to be a quiet time in Thanksgiving, this is still a major exchange and everyone is watching. A lot of people have money riding on this, and there's a tendency for things to go one way or the other in very big directions when things resume. And so I think that's a big thing that people will be watching. The pressure is on, and the sooner we get back, the better.
Okay, I think it's going to be really interesting, as you say, maybe that there's a possibility what you see here is a liquidity wave coming through, which is, as you say, could force the market in a kind of slightly unexpected direction, certainly with a significant amount of force. Nicholas, great stuff. Thank you very much indeed for the update on what is happening here. We're going to obviously track this story and bring you the latest, because this is a critical piece of market infrastructure. Nicholas Lua joining us on what is happening with the CME.
Something we're going to be continuing to monitor. One eye on the exchanges, another eye on the sales. I think it is, of course, Black Friday, the unofficial start of the holiday shopping season. Andrea Felstad is all over this, our Bloomberg opinion columnist. This year, she writes that retailers are trying to rein in discounting to cope with the impact of President Trump's tariffs, while at the same time, many shoppers are under pressure and searching for the best value for their money. Oh, gosh, I hope so. Andrea's here now to talk us about that dynamic. So we should be shopping, is what I'm hearing.
Well, I think it depends which side of the Atlantic you are. I think there's a real divide. I think in the US, the impact of tariffs, one way that you deal with paying high import duties, you don't offer as steep discounts. And we are seeing that. We haven't got any actuals yet, but in the forecast, areas hit by tariffs, toys, electronics, household appliances, we're expected to have slightly less generous discounts than they had last year, and other areas.
OK, so let's kind of unpack that a little bit. What kind of a consumer are they dealing with right now?
They're dealing with a very mixed consumer, and we've talked about the bifurcated consumer for years, but that is ever more extreme. We've got, rich people enjoying the gains from the stock market until recently anyway, and crypto. And you've got sort of lower income shoppers really, really pressed and, watching every penny, buying on deal. Generally, everyone is looking for value for money. Yeah. That means buying on discount when you can. And we saw it in July when we had Prime Day, another frenzy of discounts. Consumers were sort of buying household essentials on discount. They were looking to stock up for back to school goods, for household goods. And that really shows you that they're using these occasions not to sort of treat themselves, but to buy the things that they need more cheaply.
Can we talk about Zara?
Yes.
Finally. When I go Black Friday shopping, I go to Zara because the expectation is that you get good quality, made in Spain or wherever in the world, and it looks like it's far more expensive than it actually is. I hear they're going into another side of the business.
Well, they've already been going up market for the last couple of years. Yeah. They've been doing that, quite successfully, which is smart because the luxury brands have moved higher. Yeah. They've priced out a lot of consumers. That's led to aspirational brands like Coach, names like Cézanne doing very well. But it's also been an opportunity for Zara to pick up some of those shoppers that would have shopped luxury and capture those customers.
Inditex has Massimo Dutti.
Exactly.
Right? Dutti? Yeah. However you say it.
Cut price Cucinelli.
Yeah, they've got tons.
Exactly,
so
but
why does Zara need to do this?
They are thinking that they need to do that to capture this shopper that has been disenfranchised. And I think they have been doing that well. The thing I think that trips them up is quality. You can't, as the luxury brands have found, you can't keep charging ever higher prices without improving quality, without giving people more. Now, a year or so ago, they launched a bag range, a sort of real leather, real suede bags, very nice, but they were quite pricey and they looked good. But that's what they need to do. They need to, if they're going to go up market, you have to have that quality. And I don't think they've yet taken the quality with them.
Quality matters.
I'm learning.
Andrea Felsted, an example. Andrea Felsted, thank you very much indeed. Our high-quality opinion columnist. OK, coming up, David Hirschmann, co-head of Permira Credit, joins us in the studio to talk about deal-making and private equity. It's been quite a year for Europe.
It's been a fascinating year for Europe. This is where the growth sector is. This is a really exciting place. They're filling the sovereign funding gap. It doesn't stick into 2026. That conversation next. This is Bloomberg. Welcome back to the opening trade. 30 minutes into I'm going to say it's right. 30 minutes into today's session. It's Friday. I'm feeling it. We all are. So are these markets. And I think this is really crucial here. Futures were positive going into it, at least in Europe, were positive going into this session. Can we call it that they've paired those gains? The outperformer is a 0.1% move on the FTSE 100. Guy, rescue me. This is all I have to offer.
This is not an exciting session.
No.
It is the classic post-Thanksgiving session. There is no volume in the market. We are going to wait until Monday before we start to get a clean read on what is happening here. Today is not the day to make any assumptions about market sentiment or anything else. And it's probably even more confused by the fact that we have the CME story, which is basically taking out a significant portion of price discovery from this market. So, to be honest, we're struggling to figure out what is happening here. So what you do maybe, therefore, is look at some of the single stocks, because actually that's an area you maybe do get a slightly cleaner read on what is happening here. I hope you can read all this. Novo Nordisk is up by 1.25. These are basically the gainers within the stocks 50. Some of the industrials are doing well. Some of the luxury names are doing well. well. Look at that. LVMH is up by 0.7%. But it's the commodities out of London that I think are maybe the standout story today. So names like Glencore are up. You're seeing you're seeing quite a decent story emerging around some of these metals at the moment. What you're also getting are some decent performances coming through from the oil stocks. Now, remember, we're going into an OPEC meeting. Let's talk about what else we're getting. EssilorLuxottica. Is that a trade on the fact that we're starting to see other companies releasing smart glasses? Alibaba overnight releasing some smart glasses out in Asia. Is that negative for EssilorLuxottica? Maybe. Elsewhere, it's more of the defensive names. The safety trade is off a little bit today. So Anheuser's down a little bit, Reckitt's down a little bit. Some of the insurance companies are a little softer as well today. So there's a kind of slightly negative defensive story kind of in the market this morning. Not defensive, and that's where we're seeing maybe the weakening coming through. So that's the broader picture. But actually, today's not a day really to get a clean read on what is happening with these markets. Kriti, what else do we need to know this Friday morning?
There are a couple of other stories around the world. We'll start with the markets one. The biggest surprise I think we got today, and that of course is the trading of futures and options on the Chicago Mercantile Exchange. The CME been halted for several hours due to a data center glitch. That means trades against foreign exchange, bonds, equities, commodities, they've all been affected. A CME spokesperson says a cooling issue at a CyrusOne data center is responsible, and they are working to resolve the issue. Let's broaden it out to other things going on in the States. This time in the political space, President Trump is pushing for deeper immigration curbs after 2 National Guard members were shot near the White House. In a pair of Truth Social posts on Thursday, the U.S. president said he would, quote, permanently pause migration from all third world countries. Let's talk about what's going on this side of the Atlantic. Hungarian Prime Minister Viktor Orban will meet President Vladimir Putin in Moscow today. Now, Orban, widely seen as the most Kremlin-friendly leader in the EU, seeking to leverage his ties to Putin to potentially snap up sanctioned Russian energy assets when it comes to Eastern Europe. Now, the Hungarian leader said Russia's war on Ukraine, crude oil and natural gas supplies would all be on the agenda. Guy?
Great. Let's pick up on that story and get a bit more detail on what we should expect coming out of this meeting. We're joined now by Bloomberg Russia Economy and Government editor Greg Sullivan to talk more about this. Greg, let's talk a bit about the message that Viktor Orban is going to be taking. Is it a Hungarian message or is it a European message that he takes to Moscow?
Well, it's most likely a Hungarian message. When he spoke this morning, he said that he was going to talk about oil and natural gas supplies. That's hardly surprising because Hungary has continued to source a lot of its energy from Russia, despite the war on Ukraine, bucking the trend of other European nations. He actually received an exemption from U.S. sanctions from Donald Trump. Orban has managed to maintain close ties with both Trump and Putin. But despite energy being top of the agenda, it's also likely that the war on Ukraine will also come up. His visit is obviously taking place amid a lot of diplomatic flurry. Steve Witkoff, the U.S. envoy, is expected in Moscow next week. Putin confirmed that a U.S. delegation was coming and talks are ongoing amid President Trump's push. So that's also likely to be on the agenda when Orban visits today.
Well, Greg, it's a fascinating time as well because we know, I'm curious, and this is what I'm trying to understand here. You said it's a Hungarian-specific issue. Well, Viktor Orban has aligned himself with the leaders of the Czech Republic, with Slovakia, et cetera, a lot of these Eastern kind of European countries. How much of it creates a precedent for some of the other European countries that may be wanting to resume some of the gas supplies, especially as Vladimir Putin says maybe we're not as close to a peace deal as we thought?
Well, Orban, as you mentioned, has been seen as one of the more Kremlin-friendly leaders. He's really bucked the trend there. A bit ago, he also had a previous visit to Moscow, which he styled, it was a self-styled peace mission of his. But it provoked a lot of anger among other European leaders. And there's still a lot of pressure on him for going against the grain on things like sanctions and for not supporting aid to Ukraine. As you said, President Putin recently commenting on progress towards a peace deal and sort of tamping down expectations that, any final deal was near at hand. So there's still a lot of room for negotiations and negotiations that are yet to come here.
Greg, thanks for the update. Always appreciate it. Greg Sullivan on the Viktor Orban trip to Moscow today. It feeds nicely into a conversation that we've been having, obviously, recently about what is happening with the European defence story. If we were to get a peace deal, what would it mean for some of these defence companies? Well, we're going to find out next week. We're going to be joined by the CEOs of Hensoldt and Rheinmetall. It is a busy week when it comes to that narrative, and we've got some great guests to talk about it, Kriti.
Yeah, it's a fascinating one, and it kind of feeds into this idea of what is the growth narrative going into Europe for 2026. And defense has been such a key part of that. Energy security has been a key part of that, especially when you look at not just the public markets case, and you see that in the likes of Rheinmetall and the way it's moving the stock 600, but in the private market as well. The good chunk of the deal making and the investments in the private space this year in Europe have been energy security, data grids, defense, a lot of the projects that have been backed by sovereign governments. Let's talk a little bit more about that dynamic. I'm pleased to say one of my favorite private credit guests, David Hirschmann, the co-head of Premier's credit offering, is here around the table with us. I usually see you in Paris or Berlin or somewhere else. Welcome to the studio.
Thank you. Thank you for having me here today.
We are thrilled to have you. Let's start a little bit broad here. I want to talk just more about the European bull case. I've been interviewing you for years. Every time we talk about how private credit is kind of funding that sovereign financing gap. Is that still going to be the case going into 2026 and beyond as some of these projects and as some of these ambitions come to fruition?
Yeah, I think so. Look, Europe remains one of the most compelling credit markets in the world. Of course, there is political noise in the UK or in France right now. But by and large, the fundamentals are very solid. Policy is easing. Inflation is under control. We see it across our portfolio. With the right sector selection and asset selection, we see growth across the portfolio on a consolidated basis of around 8 to 9% at revenue level, the same at EBITDA level. So we feel comfortable with the environment, the macro environment. And clearly there is increasing demand for private debt in the market.
There absolutely is. I think one of the concerns, and we have this conversation in the public dialogue quite a bit, is one, how much of that is priced in? And if you start to see a shift in public priorities, i.e., you need to start funding welfare projects more, you need to pull out of some of the promised defense spending, you need to, I don't know, maybe there is a peace plan coming or a peace deal in Ukraine coming, for example, or you find alternative sources of energy, maybe relying on the states. If you start to see those spending priorities shift, does the value proposition of the private credit opportunities that are based on it change?
So I think the reality is we tend to focus on sectors which are not impacted and not correlated with generally public spending. So when we see an increase in the defense spending in Germany, driven by Germany mainly in Europe today, that doesn't really affect the businesses and the subsectors that we focus on. Mostly business services, insurance services, technology, healthcare services. There is some ripple effect, but by and large, they're not correlated to public spending or sovereign spending in Europe. So our focus is really to continue to remain very disciplined and invest in those sectors where there is very little correlation with either GDP growth or public spending.
Is next year the year we start to see greater divergence between management performance? Up until now, it's been really hard. Private credit's been this kind of thing. And you've looked at private credit, and it's not been obvious kind of who's doing a better job and who's not doing a better job. I'm sure from the inside it may look a little bit different. So I'd be interested in your perspective on that. But is next year the year we start to see maybe the greater divergence in performance, manager performance, being more obvious?
Maybe. And look, you're right. Not all private credit is equal. And we hear about there are cracks in the market, which is fair. I think it's true. I think it remains isolated. It remains confined to a few atypical situations. And we're talking mostly about complex financing structures, exposure to subprime, asset-heavy business models. And these are where the recent news have come from. So we may see an increase in that, but we think that those are relatively atypical situations. The main risk is not the asset class, it's pockets of the market where the underwriting discipline has slipped. So we may see an increase in that. We're not seeing that ourselves in our portfolio, but there may be a few more cases, and we've seen those in the US recently.
When are we going to know if we've built too many data centers?
That's a great question. I don't know. I mean, the demand keeps growing massively, so it's not a bet that I would make. I'm not an expert.
But it's one of those it's one of those things that everybody's watching for, that's going to affect the whole sector. The financing of this space is consuming huge amounts of credit at the moment. And therefore there are going to be ripples.
Yeah.
And when we start to know the answer to that question, it is going to affect the whole space.
Yeah, true. I mean, look, there's a broader question which effectively is at the center of all our investment decisions, which is how is AI going to impact this industry, this sector? What is the AI disruption risk? And that should be at the center and at the core of every investment decision of every manager, whether you're investing in equity or in credit, because it will have a massive impact. And so beyond the question of data centers and is there enough in capacity, but that, of course, it is one of the key questions, and everybody should have that in mind, definitely.
But to your point on the cracks, and I think that's what Guy's trying to get at in 2026, the cracks aren't as big of a deal if you have the lending growth that is fast enough to kind of minimize the spots that aren't so good, or where the financial discipline, as you put it, aren't so great. We haven't seen that. With the collapse of Tricolor and First Brands, we saw these massive impairment charges on public balance sheets, on the Barclays, on UBS, among others as well. So is the solution to dealing with that issue and the cracks just growing even faster to increase the lending growth? Do you feel like it's happening at a pace that can, overtake and can handle cracks?
So the way to overtake and handle those situations is diversification in the funds or on balance sheet if we're talking about banks. What we see is dispersion in the market, not distress. Dispersion means that the way for us to win is by remaining super selective, having funds which are well diversified, such that if there are defaults, and look, we've invested in over 200 companies, you're bound to have some defaults in any fund. A small number, but overall with a very high recovery rate. That's our experience, at least. And having small exposure to any single asset is really the key here. And where I think there have been some issues in the market, it's those either very complex structures, exposure to subprime, and lack of governance or transparency. Do we need to grow to overcome this? The growth comes from the market, from the demand. It doesn't replace, growth doesn't replace the discipline and the core investment strategy.
All right. David Hirschmann, the co-head of Premier Credit. Lovely to see you in studio. Thank you, of course, for talking about one of the major topics that are going to happen in 2026. Let's talk about another coming up on the program. That, of course, is the labor market. President Donald Trump is calling for, quote, reverse migration in the United States. Is that something that shows up in the data? Is that part of the Fed's thinking? Should it be? We're going to dive into all those details next. This is Bloomberg. Welcome back to the opening trade, about 47 minutes into this session, and we're seeing a very light one. The underperformers, the DAX this morning, the outperformers, the FTSE 100, but again, only higher by, we'll call it 0.1%. A lot of this light liquidity is also amplified by the other issue that CME futures and options trading is halted right now. There's an outage emanating from a data center that is having a cooling issue, and that means the contracts listed on your screen right now are halted. We don't have info.
This is taking a long time to fix.
Yeah, this came out at, I want to say, like 2 or 3 a.m. UK time. We're almost at 9 a.m. It's been 6-ish hours. Let's hope this gets resolved, at least certainly before the U.S. Open, when you start to see a little bit more volume perhaps hit the wire.
Absolutely. They need to get this fixed and fixed really quickly. You do wonder whether actually Thanksgiving might be a factor. I guess everybody at their desk are people actually doing what they need to do to get this up and running again. Yeah, absolutely. A conversation we're going to continue to monitor and bring you the updates. Another conversation we're monitoring is the latest coming from President Donald Trump, who says he will, quote, permanently pause migration
from third world countries. In a lengthy post on Truth Social, he said anyone who is not a net asset to the United States would be removed. Now follows the death of National Guard member Sarah Beckstrom, who was shot near the White House by a suspected Afghan national. A second guard who was also shot remains in critical condition. We're joined now by Alex Pearson, D.C. breaking news editor, who is actually in Frankfurt at the moment. We appreciate having you on this side of the Atlantic. Alex, a tragedy, of course, in the United States, but I'm curious for a financial audience how the latest comments from Donald Trump actually affect this labor market. Is this something he's threatened before? Is this something you think he would act on?
Good morning. Yeah, it's a good question. So we had this Truth Social post a couple of hours ago that outlined quite a broad immigration crackdown, even by the Trump administration standards until now. And the headline, obviously, is this permanent pause on migration from, as he called them, third world countries. It's unclear which countries that would affect. He didn't list any countries in that Truth Social post. And certainly, though, that kind of policy could have some pretty significant impact on the labor market in the U.S. in terms of specific sectors. So, you know, most migrants from developing countries tend to be lower skilled. They tend to work in, industries like construction, agriculture, hospitality. And certainly we've seen that other immigration policies this administration's taken up until now have caused labor shortages in those subsectors of the economy. And any kind of blanket ban like this that Trump has announced could also have a similar effect and exacerbate those shortages. In terms of the other policies he announced regarding foreigners and naturalized citizens already in the U.S., such as stripping them of their permanent residency or citizenship, or deporting them for not being, quote, a net asset, that's a little bit unclear. First of all, just because we don't know how quickly he could implement that kind of policy. It's not even clear he would have that kind of authority without Congress amending immigration and naturalization laws. So that still is yet to be seen.
Alex, thank you for the update. We're going to watch this very carefully. Obviously, this goes into a Fed meeting where the labour market is going to be absolutely front and centre. Alex Pearson joining us with the latest on that story out of Frankfurt. It has been, in some ways, a quiet week for markets, but a tumultuous week for markets. And it's also been a tumultuous November. What is going to happen in December? December's normally quiet, but it doesn't feel like it's going to be this year. Farah El-Brahari joins us now, leading Bloomberg's EMEA equity markets and macro trends and strategy team. Good morning.
Morning, Guy.
What a November.
Exactly, what a November.
So what happens next? Kind of where are we? I feel like we've round-tripped on the Fed, which has been probably the most critical factor in all of this.
Absolutely. You look at the S&P 500. We hit a recent low on November 20. You look at the Fed expectations that day. We were around 40% for a cut. So it was still not certain that we were going to get a cut. Next day, John Williams says he's optimistic.
Yeah, perfect timing.
Exactly. Index goes up. Swap markets are pricing in a cut, and now we're at 90%. So everyone is pretty certain at this stage that we're going to get it. And the market is still negative for the month, but we're 0.4% away. Let's see what happens with the CME glitch, but how that opens later today. We might erase the November losses, actually.
Is this all about the Fed? Is the equity markets dependent on the Fed being dovish?
At this moment in time, it's a really big factor, Kriti. So we have the AI valuations, obviously. That was a big hit to the market, but they've come back quite a bit. So the Fed continues to be a big focus, but also earnings. I mean, we just came off from a relatively strong season, double-digit growth for the S&P 500. They've beat companies that beat expectations quite a bit. The next year's forecasts are still quite elevated, double-digit growth, but that continues to be a factor for the market.
So how do you describe sentiment at the moment? Like, it feels like it's taken a few hits this month. And the Fed, I think, is kind of, obviously we've been on a bit of a round trip there. But it does feel at the end of this month that the AI trade has taken a hit. The people are more circumspect, more kind of cautious when it comes to that narrative. Crypto has come back, but not all the way. By no means a stretch of the imagination. So how is risk sentiment?
Well, if we look at the sell-side strategists, it looks quite rosy. Oh, they're really excited. Yeah. They're very excited. They have Deutsche Bank expecting the S&P 500 to go to 8,000. You have even the lowest targets that we've gotten are 7,300. These are still records for the S&P 500, about 8% gains from here. So I would say short-term sentiment has taken a hit, but long-term, or at least over the next year, everyone is still quite positive on earnings, on the Fed, on the economy being rather solid, lifting the market expectations expectations for the U.S. continues to be solid. Looking very quickly to Europe, though, it's not as of a rosy picture for the market. Stock 600 targets for next year aren't so positive. What strategists are saying is that the expectations for profit growth are way too high in Europe. We're talking about 12% from analysts. No one is really sure that we're going to get that in Europe just yet.
Is Europe still a diversifier trade away from the United States? We're going to find out.
Currency is going to be really important in that, though. If the dollar continues to go down, that's going to be... in some ways, Europe actually doesn't need to do very much to outperform if the dollar is weakening, if you are a euro investor.
I'm having deja vu. This was the conversation earlier this year. I imagine it will be early next year as well. Farah El-Barahi, who leads our Bloomberg equity coverage in this region, thank you so much for your time. I'm ready. I was in the Friday mood when I got on set. I'm ready for the weekend.
You going shopping?
No, but maybe I should, though. These Christmas markets, I hear, are open. I hear that there are lots going on in terms of Vienna, Berlin, etc. But there's some sports as well, Guy. There's the Qatar Grand Prix, the Women's Big Bash Cricket, the Australia PGA Championship. I mean, I don't even know where to start.
So there's other news. So the big news is that Kriti is not the Christmas market. The Christmas news. The big news. I'm just sort of hiding behind the flags. The big news is that Kriti Gupta, who has been with us for, what, 2.5 years?
2.5 years. You got to get you in this shot.
Is these are enormous.
Thank you for the flowers.
Is leaving to go home.
Yeah.
2.5 years. It feels like that has been too short. It's gone by in a heartbeat. It feels like you've barely been here.
Time flies when you're having fun.
Well, I hope that's true. And we've certainly enjoyed having you on our side of the Atlantic. We're not going to completely miss you because you're still going to be in New York for us.
Absolutely.
But it has been too short. So I'm probably putting you on the spot here, but thoughts of Europe? Do you feel more?
You know, Europe is great. I've gone to nerd out about Spain in a way.
You have.
That I could not have in any other part of the world, which I'm really excited about. I've had an incredible team. You actually were my first, when I was a We Markets correspondent back in New York, you and I were the first time I anchored a show with you. With anyone, was with you. So it's kind of a full circle moment that we got to be co-anchors for almost 2 years. We've had an incredible team behind the scenes. We've traveled everywhere. We've taken the show on the road. We've covered elections everywhere.
Well, that's Europe. Plenty of politics to cover over here.
It is incredible. I think we're entering an era, and we've seen this in the last year and next year. We're entering an era where the world feels like it's getting more pulled apart, less correlated. It means that in Europe, you're going to care more about the United States, and the United States, you're going to care more about Europe. And I'm really excited to be a part of that story, and I've been thrilled.
Well, it has been a great pleasure. You will be missed. You will be greatly missed once you depart. You're packing this weekend?
I'm packing this weekend. That's what I am doing this weekend.
Kriti and her dog are heading back to New York. We have missed you. We hope this is going to be appreciated. Anyway, for Monday morning, you will not be here, and you will be missed. Thank you very much indeed. Kriti Gupta, everybody.